Welcome to the On the Tape podcast, Guy Adami. I am joined by Elizabeth Thomas, formerly EY of SoFi, now just ET of things that I will figure out on later shows. Elizabeth, how are you?
I'm good. How are you? You look like you got some sun.
Yeah,
over
well,
this
you know what I
holiday.
mean? It's that time of year. And as you know, if you're living in the Atos Unis, you know that we're under some sort of, heat warnings across the country. And apparently, Elizabeth, you may know this, the hottest reading in the history of the planet, which, as far as I know, is a pretty long time, just recently took place, I think, in Death Valley out there on the West Coast. I think it was 128 degrees Fahrenheit.
Oh man, but it's a dry heat, right?
Yes, it is a dry heat. And let me say this, because I haven't seen you, a happy belated birthday to you as well.
Thank you. Thank you. You know, every once in a while I have a birthday that feels like a bigger deal than other birthdays. 40 felt like a really big deal. 42 is like totally inconsequential.
Right.
I feel no different than 41.
Well, now you're at a point in life where it's just when you change big figures. Although maybe 55 for some reason, I think people have an affinity towards that. But, once you go through the 40, it's sort of 50, 55, 60. And if you're fortunate enough, 70 and so on.
Well, the actuarial tables say 80. Well, 70 something for men, maybe 80 something for women. So I think we're both still in the clear for a while.
Well, no, it's interesting. 70 something for men really puts things in perspective for me, as I will be turning 61. So I've got a lot of runway. But that's neither here nor there. So it's great to have you back. It's great to be back. By the way, Dan sat down with Paul Rabel. He's the co-founder of the PLL. That's the Premier Lacrosse League, on OK Computer last week to discuss Paul's new book, The Way of the Champion. And as you can probably guess, we're doing a giveaway. Go to the podcast store, follow, rate, and review the OK Computer podcast. Send a screenshot to contact@riskreversal.com with your address, and we will send you a free book. So that's pretty cool. You know what else is pretty cool, Elizabeth? As we sit here on this Monday after the 4th of July holiday, stock market's effectively at all-time highs. As I like to say, why is the stock market higher? Because it's open.
Mm-hmm. By the way, I did not plan this, but I've got my OK Computer water bottle right here today. Yeah, the market's up because it's open. We hit a new all-time high in the S&P on Friday after a weak jobs number. That makes no logical sense to me. But here we are. So let's start with that.
Let's do a review and then a preview.
Yes. So let's talk about that jobs report. Here's the weird thing that's been happening with the jobs report. First of all, that was the third month in a row that the unemployment rate had risen. That has not happened in a long time. Now, that doesn't necessarily mean anything. Again, these are not big, clear signals of some sort of catastrophe coming, but the unemployment rate is on its way up. We are now across 4.0, so we hit 4.1%. That is the first time since November of 2021, I believe, that we've gotten above 4%. One of the things that I talked about in my second half outlook, and I continue to talk about in these shows and anywhere else that people will listen to me talk, is that once we get above 4%, I'm interested to see what happens in the market, because I think that we've been so used to sub 4% unemployment that now there's this mentality that it should just persist that way forever. And as we get above 4, as you know, if history is any guide, which recently it has been no guide whatsoever, but if it is any guide, once the unemployment rate starts to rise, once the labor market starts to weaken, it hits escape velocity pretty quickly. It goes up, the unemployment rate rises much faster than people usually expect it to. Now, that doesn't mean it has to happen that way. I think everybody is hoping, Fed included, Americans included, that we just sort of slowly raise the unemployment rate to the point where we solidify a cutting cycle, and then we can normalize policy without much pain. But some of the things that you want to watch in the jobs reports going forward, and this past one didn't really have a lot of these big indicators, aside from the unemployment rate rising. We had fewer jobs added, but you want to watch things like number of hours worked. You want to watch things like the labor force participation rate, because one of the things that had been happening for a while was that the unemployment rate would rise, but so did the labor force participation rate. So it was that people were coming into the labor force and were still unemployed, which was not necessarily a bad thing. Last month, not this past reading, but last month, the labor force participation rate went down and unemployment went up, which is not a good thing. So there's those little nuances that you want to watch as we go through the rest of the year. I think the market reaction on Friday and perhaps the market reaction today was that, okay, this is going to tell the Fed we can absolutely start cutting in September. We're done hiking. And now we can ease financial conditions.
Okay, fair enough. And I'm with you on all that. And I'll say this, in the fall of last year, I was one of the people that thought we'd see the unemployment rate start to move pretty dramatically to the upside early this year. That obviously didn't happen. It's starting to happen now. So once again, I was wrong. And in our business, if you're early, you are wrong. But with that said, and you've seen this as well, I mean, the revisions we've seen now, probably 13 out of the last 15 months to the downside, or something that I'm absolutely keeping my eye on. I'm not trying to make some correlation between where the unemployment rate should be and these negative revisions in terms of the jobs number, but there's clearly something going on under the surface. And I'll throw this in as well. When that starts to move, and you started to talk about that, escape velocity, that's really what starts to happen. And once that genie's out of the bottle, I think it's really hard to put back in. And I think the hope is this frees the Fed up to do a rate cut in September, as you said, with the hope that, they can assuage some of the concerns, if there are any, in the job market. But the problem is, I think once that pendulum starts to swing, it starts to swing in a meaningful way, and it takes a long time to sort of reverse that. So I'm hard-pressed to understand how an unemployment rate rising, and I think it's going to continue to rise, is somehow bullish for the economy. It just doesn't make sense. Or let me say this, forget about the economy, is somehow bullish for the stock market. I understand that people are looking at it through the lens of rates and where rates are, and we'll talk about the yield curve in a second, but it just doesn't make a whole hell of a lot of sense to me. Once again, we're in a situation where bad news is good news.
Yeah, so then a natural next question, and if there's people listening to this, they may have this question. So how high can the unemployment rate get where we're still okay? Generally, if you look in economics textbooks, classically trained, sort of what the data says, what's called frictional unemployment, which is basically the unemployment that always exists in an economy because people are moving around, things change, but it's not concerning. Frictional unemployment is, let's say, 4.5% or below. So we've still got some room. We could go from 4.1 to 4.2, 3, 4, and it's still not alarming. The interesting part about this period right now, and we compare it a lot to the 90s, this period right now, the Fed will be cutting rates into a rising unemployment picture, so into a weakening labor environment. Back in the 90s, which is the parallel that many people want to draw and say we can pull off a soft landing, it's going to be the same. Back in the 90s, the Fed started cutting rates when unemployment was 5.6%. That is concerningly high, okay? That's above the frictional unemployment rate. So 5.6%, it was falling, but we were at a period of time where the economy was actually strengthening in a lot of different ways. So this would be a different environment. If the Fed starts cutting rates in response to cooling growth, cooling labor, and inflation that's still a little bit sticky, but in a more comfortable spot, that market reaction, I think once we figure that out, that market reaction could be different from what happened in the 90s.
A lot of people look back, what was it, 95 or so, which is the last time they were sort of thread this needle. I think that's the right corollary in terms of where we are now. But so many things are different now. And again, across the globe, we'll talk about some of these elections that have been taking place. Obviously, we saw election in France yesterday that I think surprised a lot of people, and maybe it assuaged some of the concerns of the market. I'm not sure. But there's so many things out there that continue to be concerning. And I saw this from FactSet. And again, Elizabeth, you don't trade on the back of valuations, I know, but just let me read this real quick. The trailing 12-month PE ratio for the S&P is 26.4, which is above the average, 5-year average of 23.4, and above the 10-year average of 21.5. So again, we're not suggesting anybody trades on that metric alone, because that's a fool's errand. But with each passing day, what you continue to see is just effectively multiple expansion in the form of individual stocks in the broader market as well. And again, I think on the hopes of maybe these rate cuts and rates going lower, but I think some of those hopes, again, my opinion, are misguided, especially to the earlier point, if the labor market is going to cool in a way that people just don't, I think, are underestimating.
Yeah. So I used to work with this money manager, and they had statements that they would make about their philosophy, their investment philosophy. One of them was don't fight the Fed. We all know that one. Another one was don't fight the tape. We all know that one. And then another one was beware of the market at extremes. Now, I think what's happening right now, as users just mentioned, trailing PE ratios, there are a number of different measurements we can look at and say, okay, we're a little bit out of whack here, right? Things like what's the spread between the performance of the equal weighted S&P versus the market cap weighted S&P? Pretty wide right now. The valuation spread is pretty wide between the two. So many people might look at that and say, all that means is that we're top heavy. We've known that. This is not news. This is not necessarily something that is terribly concerning. It's just that the large cap names are the only ones producing solid earnings. And why wouldn't you want those compared to ones that are not producing as much growth? That's fine. That's a logical statement. If that gap continues to grow, and if those PE ratios continue to grow, even if they grow slowly, once we get to extreme levels, and if we get to extreme levels across a number of different metrics, that's where the market becomes fragile, because at extremes is when things start to look like they need to have whatever type of mean reversion might occur, or even just a narrowing of a gap just to get more rational in some of those ways. So what does that mean for what you should do in your portfolio? To me right now, what it means is that in the short term, I still think that some of this can continue. And we talked about this, Dan and I talked about this last week, I believe, that I don't think, even if there is going to be disappointment in the AI trade in earnings, I don't think it's happening this quarter. So some of this can continue to go up, even though it already feels high. But in your portfolio, it's a good time to start thinking about diversifying if you are overweight those names, if you are overly exposed, not even just to AI, but just to some of those large cap names that have done really well. Start to build in some diversification to other sectors. I'd stay in the large cap space, but build in diversification to other sectors, because if it flips, if we start to see mean reversion and a narrowing of that gap, it happens fast and you can't catch it.
I'd like to point out to the listeners and or viewers that, this is something you've pointed out for a while. I mean, you've said, both you and I have agreed, I think, in terms of the backdrop, we've both been extraordinarily concerned. And that concern, at least for me, has given me this sort of bearish tilt to things, which has been wrong. You've felt the same way in terms of what you're seeing, but you've also been smart enough and sort of ahead of the curve enough to state that, you know what, I see all the things that you're seeing, Guy, but that doesn't mean this thing can't continue to levitate and do things that people are not expecting to the upside. And that's exactly what's taking place. And I think you're right to continue to point that out. Your point about when it turns, it's going to turn quick. I agree with that 100%, because when you never see the turn coming, and listen, over the last few months, there have been a number of things that should have turned the broader market, and it has not. So I'm hard pressed to understand what those are going to be. Obviously, I think this week, and we're going to talk about a few things we have this week, and I don't want to talk about politics, but it's a pretty important week, I think, for the Democratic Party in terms of, is Joe Biden going to sort of acquiesce? He has suggested he's going to stay the course, but seemingly a lot of pressure. I have no idea if he were to step down from being the nominee, what that means for the market. But again, that's out there as well. So many things are out there. And I'll throw this in real quick, in terms of the market. Yeah, the S&P all-time highs, effectively the NASDAQ, the whole thing, we get it. The Russell through the lens of the IWM, which is probably, by the time you're listening to this, is going to be around 202.5, 203. But still, that 208 level has been extraordinary resistance to the upside. And, I guess maybe the last piece of this puzzle, and, small caps better than just about anybody out there, might be participation in the form of the small caps, which, we haven't seen now for, well, I'm going back to, I want to say November of 2021, when the small caps, again, through the IWM, made its all-time high.
Yeah, and we've seen participation in those periods of time where the narrative is about broadening out. So you'll see small caps rally a little bit, but they don't ever get out of their own way. They don't ever break out. They don't create, they haven't had a new high since then, despite the fact that all the other major indices have. So the fact that small caps can't quite get above some of that range, and I would say there's a topping range that they haven't been able to get above that. People might ask why that is. Part of it is that rates are still higher than they have been for a long time. Yes, they've come down. Yes, we've seen some re-steepening of the yield curve, but rates are still higher. Small cap companies tend to have more floating rate debt. So as long as rates stay elevated, that is a problem. Small cap companies also tend to finance things over shorter periods of time because that makes it easier for them to get capital. So as long as short rates have stayed high, That's pressured them too. And then you have to think about just what's going on in growth land. So if you've got a discount rate that has stayed elevated, the future earnings of small cap companies under pressure, it's more difficult to justify a higher valuation today. So there's a lot that's kind of working against them. And then if on the flip side of that, we know that small cap companies make up the majority of the labor force in the US. If small cap companies can't quite get above their prior highs and can't quite find a breakout, then we've got a labor market that continues to have a lid on it as well.
All right, so that's our look in the past. Let's look in the future a little bit. And this week we have some economic data, but first let's look at the earnings calendar this week. And I'll say, according to FactSet, the S&P 500 are expected to report a fourth straight quarter of earnings growth, with profits projected to have climbed almost 9%, 8.8% from last year's second quarter. That would mark the biggest increase since the first quarter of 2022. So we're right back in the earnings season. And this week it's in the form of Thursday with Delta Airlines and Pepsi, obviously two very different things. But Friday, to me, is the important one. It's JP Morgan, Wells Fargo, and Citi. And I know you don't comment on individual stocks, so I'm not going to ask you to. But I think it's interesting that it was now probably a month and a half or so ago-ish when Jamie Dimon came out. And again, I don't know what prompted this response, but he effectively said, and I'm paraphrasing once again, that the stock was too expensive, the stock being JP Morgan, to sort of look to buy back the stock. And, I agreed with him at the time. I think the stock was trading about 198. The stock maybe got down to 192, but as we're sitting here north of $200, JP Morgan trades extraordinarily well. Some of these other banks do as well. My question to you is not stock specific, but, more in the scope of, how important do you think bank earnings are for the broader market as we get into it later this week?
Well, I mean, they're always important as an economic indicator. How has money flowed around the economy for the last quarter? What's the demand for borrowing from clients, whether those are institutional big money clients or retail clients? Because when you look at borrowing, a lot of times, even a healthy growing economy, you do see an increase in bank lending, you see an increase in borrowing, and that's okay as long as consumers and businesses can sustain it and make their payments. Now, we've been concerned for a while about the credit card debt. That's some of what I want to hear from bank earnings. And I also, when you look at just financials more broadly, which we're not going to hear from these this week, but some of the credit card companies, I want to hear from them about, has activity slowed down? I don't think we're going to get anything terribly concerning about delinquencies yet from them, but we might get some indications that confirm that the consumer has actually pulled back on spending. So if we hear that some of the credit card activity is down, or some of the borrowing activity in the consumer space is down, that would confirm what we've already suspected. The consumer is making some changes. The consumer has hit a little bit of a pause button on what seemed like just indiscriminate spending for a long time. So I think all of those would come together to solidify a case that the economy is cooling, not dying, but cooling, and bank earnings are important to show us that. The big banks obviously have a bunch of other revenue streams that they can lean on, even if the consumer is cooling. So it will also be interesting to hear that. I would expect things like capital market activity, now that we've hit another new all-time high. I don't know how many that is this year, but it's a lot. Capital markets activity probably adding and still looking healthy. But again, always interesting to hear from Jamie Dimon. Also interesting, last week, the announcement that came out about Marko Kolanovic leaving JP Morgan, and he was the most bearish on the street. He had the most bearish target. I believe he had the most bearish target, and he had stuck to his guns on being bearish that way, which I find it interesting because that was still in line with a lot of the things that Jamie had warned about. Now that Marko has left, I just think there's a lot of interesting stuff going on in bank land, in big bank land right now.
Yeah, no question. I think Marco's targeting the S&P, I think, and we can put it in the show notes. I think it was like 4,200 or so. It was, if it wasn't 4,200, it was pretty close to that. And obviously, as you said, he was low on the street and he had stuck to his guns for quite some time. And I'm not suggesting his bearish forecast, which has not come to fruition, somehow forced him out, although a lot of people will draw that line. Who knows? But that comes obviously many months after Mike Wilson seemingly acquiesced a while back in terms of his views as well. Again, I don't think Mike has changed fundamentally what he thinks is going on, but he also sort of acknowledged that this price action was pretty powerful. And the question I guess I'll ask you as we get into bank earnings, we're now not the middle of July, but early July, second half of the year, the fact that the market's done as well as it does it seemingly become just sort of this now chase for people that have been sort of idly watching, waiting for what I've thought was going to happen that has not. And to a certain extent, has become self-fulfilling in what are typically pretty quiet summer months.
It could. What I talked about before is beware the market at extremes. I don't think we're at those extremes yet. If a chase begins, that's what takes it to extremes, because it's that FOMO that continues to drive things up to an unreasonable level. And then there's overexposure, and seemingly the entire market is not positioned properly for the risks that are out there. So that doesn't necessarily increase any of the economic risks. It doesn't necessarily increase earnings risk. It just increases multiple risk, and it increases exposure risk and concentration risk. So when you look at things like that, as the market gets to extremes, if it does, that's when you want to be careful. So far, it has not gotten there. We've had little pullbacks here and there that bring it back down to under extremes. But as you suggest, if there is a chase, if there is this, oh my gosh, I've missed it until now thing, then we probably end up at extremes sooner rather than later.
Well, what's interesting, I mean, clearly there's a chase going on in a couple of individual names. And again, I'm not asking you to comment, but I will. I mean, Apple, as we're sitting here, an all-time high north of 225. You've seen a pretty extraordinary move out of Tesla, much to the consternation, I'm sure, of a lot of people out there. But, it is what it is. And that move, although still significantly lower than its all-time high, has been pretty remarkable over the last couple of weeks or so. Obviously, the other names we talk about all the time. So there's something going on in terms of a chase, without question, in terms of those names. I'll tell you what there's not seemingly a chase for, and I don't really understand what's going on. And again, I'm not asking you to opine unless you're looking to, is Bitcoin. I think Bitcoin got as low as 54,500 or so over the weekend. We're either side of 57,000 right now, but that's been a pretty interesting drop. And I only mention it because if you had told me that rates, 10-year yields would have come off the way they have, where's Bitcoin going to be? I would have said Bitcoin's probably making a new all-time high. So Bitcoin, for whatever reason, is sort of bucking the trend. And again, I am not here. I'm not equipped to try to understand what's going on in Bitcoin, but through my limited understanding, I would have thought that a more potentially an earlier rate cut than the market was looking for would have been supportive of Bitcoin, Elizabeth, and has not been.
I would have thought that too. People might be wondering why that's the assumption. If rate cuts are coming, and rate cuts have already begun around the globe, if rate cuts are coming here, the expectation over a period of cuts, if we enter a cutting cycle, is that the currency would drop as well, and that we just wouldn't have quite as strong of currencies. And if all the major currencies lose some steam, obviously some stuff happening in Europe over the weekend, if the euro starts to lose more steam, if the dollar weakens, then what's the alternative? Things like gold or Bitcoin. What's happened with Bitcoin recently, I can't explain that either, and I struggle to explain a lot of the big moves in Bitcoin. But what we have seen that I think has been pretty consistent is that when there is what would be considered a dash for trash, if there's a rally where we've got a bunch of stuff that we would say are, crappy earnings or whatever types of companies that are rising for no real apparent fundamental reason, or perhaps in a meme craze where we've got no real apparent fundamental reason, typically you do see crypto rise with some of those as risk appetite gets slightly unhinged for a period of time. So maybe it's nothing more than just saying risk appetite is not unhinged right now. Perhaps there are investors out there that are starting to say, you know what? Things are cooling off. I'm not going to get completely crazy about this. And maybe that's what's keeping the market away from those extremes that I talked about before.
You mentioned extremes and you talked about the top heaviness of this market. And there was a Wall Street Journal article and they quoted Torsten Slok, and he is the chief economist at Apollo Global. So I'll just sort of read a couple things to you because I think this sort of illustrates and galvanizes the point that you were making earlier. The top 10 companies in the S&P 500 right now make up 37% of the index's market cap. So that's 10 out of 500, or 37% of the market cap, and contribute 24% to the earnings. That's the widest gap since the third quarter of 1990. So 37% of the market cap, they contribute 24%. I think he's looking at those two numbers, and they're both staggering in terms of the importance of those names. And maybe, listen, Maybe that's just the environment they're in, and maybe those names can carry the water for a period of time. But man, oh man, when you're that top heavy, you have to be somewhat concerned, I would imagine.
Yeah. Well, you know what's funny is those stats, you could actually take the other side of that and say, well, that's why we're top heavy,
Right.
because they're the only ones earning. They're contributing a quarter of the earnings. Of course, people are buying those stocks. Why wouldn't you? Liz just went on a tangent about no fundamental evidence of things rising. Maybe those are the only companies that do have fundamental evidence to be purchased and continue rising. And I can't argue with that, right? That's true for now. That is true. I do think at some point the clip that we've been moving at, particularly in those names and earnings and surprising to the upside and making up that large of a proportion of the overall index earnings, that speed has to slow down. And that would be what we'll call a second derivative effect. So the speed of that growth probably slows down. That doesn't necessarily mean that it has to be this big disappointment, but we're probably not going to grow at this rate forever. And how will the market digest that? Will it narrow the gap between the performance of those and some of the rest of the stuff?
All right. So that's sort of the look ahead in terms of earnings and some of the other things that we talked about in terms of the top heaviness and some of the numbers around it. Let's take a look at the economic calendar. And, later today obviously being Monday, we're going to get a consumer credit report for May, which is somewhat interesting, I think. Tomorrow, Tuesday, early in the morning, the NFIB small business optimism for June. That's something I know you look at. We got some Fed speak on Tuesday without question. We have wholesale inventories on Wednesday. I think Chairman Powell testimony before the House also on Wednesday. But the big things I think this week, and I know you can speak to this, is CPI for June on Thursday at 8:30 a.m. and on Friday, PPI for June also at 8:30 a.m. Oh, and by the way, real quick, and throw in the University of Michigan on Friday as well.
Yes. And remember, I mention this all the time. There's University of Michigan and there's Conference Board. University of Michigan skews more towards inflation. Conference Board skews more towards labor. So we're going to get a lot of inflation data, and then we're going to get a sentiment number that does skew more towards how consumers are feeling about the inflation environment. So I think we're going to get a really good read on inflation this week. The CPI expectations, if we look at headline CPI, which includes everything, at this point, expected to come in at 3.1% year over year. Core CPI expected to come in at 3.4%. That core number would be holding steady with last month if it does come in at 3.4. 3.1% on headline would be below last month. Last month was 3.3. So again, I think we'll get a repeat effect of if we surprise to the upside or the downside, the market will react to that. If we get either bang on expectations or even a slight miss, like a surprise to the downside on CPI and or PPI, I think we start to see that September cut get all but entirely priced in. We're at about 77% right now. I don't think anybody is going to start to believe that we're getting a July cut. That's just coming way too soon, unless there's some sort of catastrophe that happens in CPI and PPI or some other news. But that always is a chance. You can't trade or prepare yourself for some sort of black swan event every single day. So if we start to see movement in CPI downward, continuing to move downward, if we see PPI come in downward, then I think that September cut probability goes from 77% probably into the 80s pretty quickly, and you continue to see yields fall. Now, what's happened in the yield curve for parts of this period is what's called a bull steepening. We had a twist steepening for a little while, but a bull steepening where both the 10s and the 2s fall, but the 2s fall faster. So what's happening is we're starting to see that inversion get a little bit more shallow, not as shallow as it's been, but get a little bit more shallow as we get closer and closer to that first Fed cut. And perhaps even once we get to Jackson Hole, I bet we're going to continue to see bull steepening in that curve with the 2s coming down.
I'm glad you mentioned that because that was to be my next question to you, but you beat me to the punch. And I think, again, politics are not interesting to me at all. But I think to a certain extent, the bond market might start to be playing a little bit of politics as well in terms of who they think the potential president in November could be, who the candidate potentially could change to on the Democratic Party. There's so many things up in the air right now. And I do think to a certain extent, the bond market is reacting to that as well. As we're sitting here right now, 10-year yields are probably about 4.29 or thereabouts. I think we got up to almost 4.5% a week and a half or so ago. So the bond volatility is still there. but you mentioned that we're steepening again. I think we got down to about 14 basis points of inversion earlier this year. As we're sitting here, it's probably about 30 or so basis points. I don't know how the market's going to react to a yield curve that continues to steepen and maybe even flattens at some point. But I will tell you, and you've said this, that historically, it's not the inversion that gets you, it's the re-steepening, and it's sort of happening right before our eyes.
Yep. And one of the things that you will continue to hear me say through a re-steepening environment and be very clear about is that the sectors that tend to do well in a re-steepening are things like staples, utilities, healthcare, and energy. Those sound like defensive plays aside from energy. They sound like defensive plays. When I talk about those sectors, it is not purely a defensive play. It's the fact that those are the ones that tend to consistently do well in the environment that I would expect to come to pass in the second half of this year as the Fed embarks on a cutting cycle. Some of the reasons that that happens are because those are the sectors that pay a good dividend. So as you've got interest rates coming down, people not earning as much on money markets or cash, they want to earn somewhere else, but still have capital appreciation potential, which means owning equities that pay a good dividend. Now, you could play that game. If you just want to play the dividend game, you could play that game by just buying a dividend ETF and looking for just dividend paying stocks that would probably give you a lot of similar exposure just in one fell swoop.
It is great to see you once again. I noticed you got your haircut. I'm sure some of our keen observers noticed that as well. Good on you. As they say, we reviewed, we previewed. We had a couple of giggles without question. It's nice to be back in the seat. It's great to see you. Remember, Dan sat down with Paul Rabel, again, the co-founder of the PLL on OK Computer, to discuss Paul's book, The Way of the Champion. Again, check that out. We're doing a giveaway. Go to the podcast store, follow, rate, review OK Computer Podcast. Send that screenshot to contact@riskreversal.com with your address, and we will send you a book. E.T., it is great seeing you. I hope to see you later this week.
You definitely will. Thanks, everybody.
Thanks, everyone.